Welcome to the Opening Bell Report.
I'm really thrilled you're here today.
Yeah, glad to be here.
Because to you, the learner listening right now, we are about to challenge absolutely everything you might assume about standard stock metrics.
We really are.
We're going to completely flip the script on how you evaluate a balance sheet. So today's mission is highly specific. We've got our hands on a single, really comprehensive analysis report, and we're using it to understand exactly why Wall Street analysts are aggressively, unanimously, backing a company that makes zero money.
It's wild.
Literally not a single cent in revenue, yet the smart money is just pouring in hand over fist.
Right, and it's the ultimate paradox of the stock market, isn't it? You're taught from day one to look for profits, revenue growth, solid margins.
Exactly, the base.
But in certain sectors, playing strictly by those traditional rules means you'll completely miss the most explosive opportunities. So the data we're diving into today provides an absolute masterclass in why context is everything when you're looking at financial health.
It really does. And the inciting incident that brings us here today is a headline number that jumps right off the page of the analysis report. Immunic Inc., which trades on the NASDAQ under the ticker IMUX, just surged 10.81% in its latest session.
Yeah, a huge jump.
Which pushed the price to what sounds like a very modest $1.23 per share.
$1.23.
Right. But don't let that penny stock price tag fool you for a second. Okay, let's unpack this.
Let's do it.
Why is a tiny stock sitting at $1.23 triggering a massive institutional buy-in and a completely unanimous strong buy consensus from Wall Street?
Well, to really grasp that, we have to recognize that this isn't just about a stock bumping up 10% on a random Tuesday.
Right, it's bigger than that.
Much bigger. This is a fascinating case study in how biotech valuations actually work under the hood. It highlights the incredibly delicate balance between clinical risk, meaning, does the science actually work in human patients?
Always the big question.
Exactly. The balance between that and financial runway.
Right.
Meaning, do they have enough cash to keep the lights on until they can prove it?
Right.
And what the analysis report lays out so clearly is how Immunic has managed to completely rewrite its narrative on both of those fronts over the last few months.
So let's dive right into the science, because that's really the foundation of this whole story. We're not talking about another generic painkiller here.
Or like an incremental improvement on an allergy pill.
Exactly. The disease context is crucial. The analysis report notes that the global multiple sclerosis market is a $25 billion arena.
It's massive.
It's a massive market, primarily because it's such a devastating, complex disease, and patients require lifelong management.
It's massive, but it's also highly consolidated. You have current giants like Biogen, ticker BIIB, and Novartis, ticker NVS, who absolutely dominate this space.
The heavyweight.
Right, the heavyweights.
Yeah.
But their dominance is built on legacy treatments that are far from perfect. The report points out that these treatments usually involve harsh injectables or oral drugs that come with a severe burden of side effects.
Awful side effects for the patient.
Yeah. And think about what these drugs actually do. From a clinical standpoint, their primary goal is essentially defensive. They're immunosuppressants.
They just tamp down the whole system.
Exactly. They tamp down the entire immune system to stop it from attacking the nervous system, which is great for halting new lesions, but it leaves patients incredibly vulnerable to other infections.
And they don't fix the damage that's already there.
No, crucially, they don't do anything to fix the damage that's already occurred.
Right. They're just playing defense. The data draws a really stark contrast here when introducing Immunic's drug. It's called vidofludimus calcium.
Yep, or IMU 838.
IMU 838.
Yeah.
It's an oral pill, and the way the mechanism is framed is incredible. If you think of traditional MS drugs like firemen who show up to a house fire.
I love this analogy.
Right. Their entire job is to spray water and just stop the fire from spreading to the rest of the house. They aren't fixing the charred wood or the broken windows.
Right.
But vidofludimus calcium is trying to actually rebuild the house while it puts out the fire. It's classified as a dual threat mechanism.
What's fascinating here is the precise biological mechanism behind that dual threat. The data highlights that this drug isn't just anti-inflammatory,
Right.
Putting out the fire. It's actively neuroprotective.
Which means
It utilizes something called Neur1 activation. Now, Neur1 is essentially a master switch in the brain that controls inflammation and protects neurons. Traditional drugs just build a wall to keep the immune system out.
right.
But activating Neur1 actually tells the cells inside to start repairing the damage.
Rebuilding the house.
Exactly. And this provides an incredibly clean safety profile because you aren't just nuking the patient's immune system. More importantly, it's shown the potential to help reverse or stabilize current disability in patients.
Which is huge.
In the world of neurology, a drug that can actively protect and potentially repair neurons is the holy grail.
And that brings us to a massive turning point. The report notes that early 2026 marked what's being called a regime change for this stock.
Total shift.
Let's rewind a bit to set the stage. In late 2025, the stock was heavily beaten down. It had fallen to a floor of just 51 cents.
51 cents.
The market had basically written it off. But then came the Phase 2 caliper catalyst. The data from those trials dropped, showing significant disability improvement in MS patients.
You cannot overstate how vital that Phase 2 caliper data is for the broader context of their evaluation.
Because it's so rare.
Yes, in neurology and specifically in MS trials, proving actual disability improvement is a remarkably rare feat. Most clinical trials pop champagne if they just show a slight slowing of disease progression.
Wow, just slowing it down is a win.
Normally, yes.
Yeah.
So when Immunic demonstrated that patients were actually experiencing significant disability improvement, it fundamentally shifted the risk profile of the entire company.
It proved it wasn't just a theory.
Exactly. It proved the underlying science wasn't just a promising theory in a petri dish. It was actually working in human trials. That's the exact moment the regime change began.
That makes sense.
That's when institutional investors, the ones who have teams of PhDs analyzing this data, started paying very close attention.
But here's where the disconnect happens for the average investor. If you just looked at the traditional financials right after that massive Phase 2 win, you'd probably run away screaming.
Oh, absolutely.
Let me play the skeptic for a second and read off these seemingly terrifying financial metrics from their year-end 2025 and Q1 2026 reporting that the analysis report lays out.
Wait for it.
Ready for this? Revenue, $0.00. A quarterly operating loss of roughly $25.6 million.
Driven by the Phase 3 INSURE trials, yeah.
Right. An EPS of negative $2.60 and a jaw-dropping return on equity of negative 867%.
It sounds bad.
Wait, standard or not, a negative 867% ROE is terrifying. If I went to a bank and asked for a loan with a negative 867% return on my personal equity and zero income, they'd laugh me out of the building.
They'd literally call security.
Right. So how do institutional investors look at a number like that and not immediately walk away?
They'd absolutely laugh you out of the bank.
Yeah.
If you were looking at a retail company or software firm, those numbers would mean bankruptcy is imminent. But in the context of a clinical stage biotech, these numbers aren't just standard. They're the necessary cost of entry.
Okay, so it's a completely different game.
Completely different.
Yeah.
Let's look at negative valuation ratios like a PE of negative 1.65 or an EV to EBITDA of negative 3.63x. These metrics are highly misleading here.
The report compares them to TG Therapeutics, right? Ticker TGTX.
Exactly. TGTX recently pivoted from this exact same heavy burn phase into profitability. Immunic's PE is incredibly negative simply because they are investing every single dollar they have into capturing a piece of that $25 billion MS market.
Every dollar goes into the research.
Right. That $25.6 million quarterly burn rate isn't executives buying private jets. It's the cost of running massive global Phase 3 trials across hundreds of clinical sites. It's an investment in future monopoly, not a structural failure.
Okay, I hear you. The burn rate is justified by the massive potential payoff at the end of the rainbow. But you still need cash to burn, right?
You do.
At what point does a managed burn just become a bonfire? You can't run a global Phase 3 trial on hopes and dreams.
No, you definitely cannot.
Here's where it gets really interesting. The analysis report details a massive lifeline that completely changed the company's trajectory and explains why Wall Street suddenly doesn't care about that negative ROE.
This is the turning point.
In February 2026, Immunic closed an oversubscribed private placement for up to $400 million.
And that word oversubscribed is the key to this entire puzzle. It means that institutional investors wanted to give the company more money than the company was even asking for.
They were begging to get in.
Yes. Think about the due diligence required for a $400 million private placement. These aren't retail day traders jumping on a meme stock.
No.
These are sophisticated healthcare funds, institutional whales, who get full access to the clinical data rooms. They looked at the Phase 2 caliper data, saw the Neur1 activation actually working, and essentially said, take our money to get this across the finish line.
And let's break down what that $400 million actually does to the new balance sheet, because it's night and day.
Oh, it really is.
Immunic now sits on over $215 million in cash on hand, which includes the upfront proceeds from that raise. Furthermore, their debt is nominal, only about $1 million, so you have a completely clean balance sheet.
Exactly. And let's tie that back to your question about the bonfire. Their free cash flow sits at negative $19.3 million, which they describe as a managed burn.
Meaning they know exactly where it's going.
A managed burn means they are spending predictably and efficiently against a known timeline. Because of that massive raise, their cash runway is now extended well into 2027. This is the crucial differentiator in the biotech sector.
Because others are struggling.
Yes. The data contrasts Immunic with struggling peers, companies like Genero or Passage Bio. those companies are constantly fighting for funding. They're caught in a dilution death spiral, having to constantly issue new shares at lower and lower prices just to keep the lights on, which destroys the value for existing shareholders.
But Immunic avoided that.
Because of this private placement, Immunic doesn't need to dilute its roughly 164 million outstanding shares to survive before their next big data release. The financial risk, which is the #1 killer of biotech companies, has been entirely eliminated.
Which perfectly explains Wall Street's verdict. You have a clinically de-risked drug with the caliper data proving the science works, and a financially de-risked balance sheet with the $400 million raise ensuring they don't go bankrupt, proving it.
Exactly.
So it makes total sense when I look at the analyst consensus right now from the report. 8 buys, 0 holds, 0 sells. That's a 100% strong buy rating across the board.
It's incredibly rare to see that level of unanimous agreement among analysts, especially in a sector as notoriously volatile as biotech.
There's usually someone holding out.
There's almost always at least one skeptic or someone playing devil's advocate with a hold rating. But the combination of the dual threat MS data and the massive cash infusion has essentially forced the analysts' hands. The math is just too compelling to ignore.
And the price targets they're setting reflect that. We're looking at an average price target of $4.87. Remember, the stock is currently trading around $1.23.
Yeah.
Even the most conservative, lowest target on the street is $3.03, which is still more than double the current price. And the highest target is a staggering $10.50.
To put some context around why those targets are so aggressive, there's a great direct quote from the investment bank H.C. Wainwright from March 2026.
What did they say?
They maintained their buy rating and specifically stated that the $400 million raise, quote, de-risks the entire clinical program.
De-risks the whole thing.
When an analyst says a program is de-risked, they're sending a very specific signal to their institutional clients. They're saying the major structural hurdles, bankruptcy, or having to stop a successful trial simply due to lack of funds are completely off the table.
The table is cleared for the science.
The focus is now entirely on the upside potential of the drug itself capturing market share.
So if the fundamental story is this strong, are we seeing that reflected in the actual trading behavior? Because a $1.23 stock usually has a pretty ugly chart. Let's look at the technical analysis.
If we connect this to the bigger picture, the stock chart from the report tells a very compelling story of quiet accumulation.
Quiet accumulation.
Yeah, we're seeing a bullish breakout above the 200-day moving average. For technical traders, crossing that 200-day line isn't just a blip, it's a major signal of a long-term trend reversal.
Okay.
We talked about how the stock hit a floor of 51 cents in late 2025. From that bottom, it's formed what's called a rounded bottom pattern.
And a rounded bottom usually means what? That's not a sudden hike spike, right?
Exactly. It typically indicates a slow, steady accumulation of shares by large players rather than a quick, volatile spike driven by a retail frenzy.
With smart money moving quietly.
Smart money buys quietly so they don't spike the price on themselves. And right now, it's testing resistance at its 52-week high of $1.35. It's pressing right up against that ceiling.
But it's not just creeping up quietly anymore. The data points out a massive volume spike recently. We're talking about 3.3 million shares trading daily.
Which is huge.
That's a huge surge. The analysis explicitly interprets this as strong institutional accumulation. The smart money is actively moving in, buying up shares, which has pushed the total market cap up to $160.48 million.
That volume is the unmistakable footprint of institutional buyers. Retail investors rarely generate a sustained 3.3 million daily share volume on a microcap biotech stock without major headline-grabbing news on that specific day.
It's deliberate.
This is sustained, deliberate buying. These funds are building their positions right now before the broader market fully catches on to the implications of the Phase 2 data and that secured cash runway. They're getting in while the price is still anchored to its pre-revenue status.
So, for you listening, what's the actual timeline here? If you're watching this play out, there are two major things on the immediate horizon you need to track. First up is the expected Q1 earnings release, which is slated for May 14th, 2026.
But here's a critical warning for the listener.
Yeah.
Do not be distracted by standard earnings metrics on that May 14th date.
Because they'll look terrible.
Exactly. As we've discussed at length, the EPS will be negative, the revenue will be zero. The financial media might splash a headline about a miss on earnings, but that is entirely irrelevant to the company's true valuation. The true catalyst, the ultimate make-or-break moment for this stock, is the top-line Phase 3 INSURE data readout.
And that's expected at the end of 2026.
Yes.
Right, the earnings report is just a check-in on the burn rate. The INSURE data is the actual report card on the drug.
Precisely. The Phase 3 readout is what will prove if the disability improvement seen in Phase 2 holds up across a massive global patient population. If it does, that's when you see biotech valuations go parabolic, because they are suddenly holding the keys to a commercial blockbuster.
So what does this all mean? We've covered a huge amount of ground today, from the deep science of neuroprotection and Neur1 activation to the intricacies of cash runways and how institutional volume leaves footprints on a stock chart.
A lot of ground.
The overall consensus we're looking at essentially summarizes the situation like this. The recent 10% surge to $1.23 is viewed not as the end of a short-term rally, but merely as the start of the climb.
This is the beginning.
And that's entirely because the Phase 2 caliper data proved the drug does something genuinely extraordinary in a $25 billion market, while the $400 million capital raise completely eliminated the financial risk of actually getting that drug to the finish line.
It's the perfect storm for a biotech valuation reset. The negative PE ratio and that terrifying negative 867% ROE are just artifacts of a company in a heavy build phase.
They're just numbers on a page right now.
The reality on the ground is a fully funded path to a Phase 3 data readout for a drug that could fundamentally disrupt how we treat one of the most complex neurological diseases in the world. When you separate the clinical reality from the standard financial screeners, the Wall Street strong buy consensus suddenly makes perfect sense.
Thank you so much for joining us on this deep dive. We've journeyed from understanding why confusing negative PE ratios are completely normal here to grasping the massive disruptive potential of a dual-threat MS drug backed by $400 million in fresh capital. We've seen exactly why Wall Street analysts are ignoring the zero revenue today and focusing entirely on that 2026 finish line.
And this raises an important question, something for you to think about long after this deep dive ends. If a relatively small, $160 million clinical stage biotech can discover an oral mechanism that doesn't just halt neurological damage but potentially stabilizes or reverses it, what other major quote-unquote incurable diseases are currently being treated by pharmaceutical giants just for symptom management, while the actual reversal key is sitting quietly in a pre-revenue clinical trial somewhere?
That's an incredible thought to leave on. There's always more beneath the surface if you know exactly where and how to look. Keep digging, keep questioning those baseline assumptions, and keep learning.
Don't forget to like, share, and subscribe for more.